Welcome to the Investor's Library, where we try to cut through the noise and help you find some of the most interesting investment opportunities.
Think of it as, we're your guides, sifting through all the financial data to bring you the best ideas.
And today we're diving into a corner of the market that I know a lot of people are really interested in right now.
Yeah.
High-yield dividend stocks.
These are companies that offer potential for growth, but also reward their investors with a nice steady income stream through dividends.
Exactly. And we've actually put together a list of 10 stocks. They're really making waves in January of 2025. These are companies that have a history of really solid performance and a real commitment to sharing those profits with their investors.
Now remember, high yield often comes with a bit more risk, so we'll make sure to unpack both the exciting potential and the things to watch out for.
Okay. So let's jump right in, and let's start with a company that I think pretty much everyone's heard of. Altria, the tobacco giant.
Yeah. I know what you might be thinking. Tobacco. Like, really? But here's the thing. Altria is currently offering a 7.83% dividend yield.
Wow.
And they have an incredible track record of 55 years of consecutive dividend growth.
55 years. That's longer than I've been alive.
Yeah, it speaks to their commitment to, delivering value to shareholders. Even in the face of some challenges in the industry, they've been adapting too, Altria is diversifying beyond just the traditional cigarettes and investing in smokeless tobacco. They're even starting to test the waters in the cannabis market.
So, they're not just sitting around. They're really trying to evolve and find new opportunities.
Exactly. But of course, nothing is without risk, right? The tobacco industry is definitely facing shrinking demand, and there's always that regulatory pressure.
Right. So, important considerations for anybody who's thinking about investing.
Absolutely. You always have to weigh the factors, the potential rewards and the risks.
Okay. So moving on to a company in a completely different space. Aristocrat Capital Corporation. This is an asset management firm.
And this one's especially interesting, I think, for those income-focused investors. Ares Capital has got an 8.68% dividend yield.
Wow.
That's actually the highest on our list today. And they've been really consistently growing their dividend for the last few years.
That's pretty incredible.
Yeah, and what's driving that is that they lend money to middle market companies. These are companies that are sometimes overlooked by banks, but they have a ton of growth potential.
So they're really filling a need in the market.
Exactly. But lending to middle market companies can come with its own risks, right?
Sure.
These companies are vulnerable to economic downturns or even challenges specific to their industry.
So, I guess really important to look closely at that loan portfolio and just really see what industries are they exposed to.
You got it. Okay, let's switch gears a little bit. Let's talk energy sector. A company making headlines, Chevron Corporation.
Ah, Chevron. I mean, with oil prices soaring above $80 a barrel, they must be doing really well.
They are, and they are sharing the wealth. They've got a healthy 4.43% dividend yield and a really solid history of dividend growth. 37 years they've been increasing dividends.
That's a pretty solid track record.
Yeah, they're also investing a lot in new projects, technologies, just making sure that they're staying competitive in this ever-changing energy world.
But as we all know, energy it's a volatile sector, right?
Yeah.
What goes up can come down pretty quickly.
That's true. Oil prices are affected by everything from global demand to, events happening around the world.
Right.
Investors need to be aware of that, and just be comfortable with that.
Yeah, so it's really all about understanding, the risks and just being prepared for any kind of swings in the market.
Exactly. Now let's stick with energy for just a second, but with a slightly different twist.
Okay.
Enterprise Products Partners.
I'm intrigued what makes them stand out.
Well, unlike Chevron, who produces oil and gas, Enterprise Products Partner focuses on the midstream segment. So they own and operate pipelines, storage facilities, processing plants.
So they're kind of like the backbone of the whole system.
Yeah, you could say that. And because their business is not so directly tied to, the price of oil and gas, they can offer more stability.
Got it.
Which you can see in their dividend yield, 6.58%.
Interesting. So they're a little bit more insulated from those big swings in the energy market.
To some degree, yeah. But you got to remember, long-term demand for fossil fuel infrastructure is always a question mark.
Right.
Especially with, the push for renewables.
Yeah, that's definitely something to keep in mind.
Absolutely. Okay, Let's take a break from, the heavy industries and talk about something a little more fun, Nestle.
Ah, Nestle. I mean, who doesn't love chocolate, coffee, ice cream?
Right, and they have that global reach, and just those iconic brands that people have loved for generations. That translates into a really nice 4.01% dividend yield and a history of consistent dividend growth.
So no matter what's going on in the world, people are still going to be buying their Nestle products.
Pretty much. But even Nestle, faces some challenges, right? Currency fluctuations, the economy slowing down in some parts of the world.
So, you gotta keep in mind those global factors.
Of course. Okay, ready for another household name?
Yeah.
Let's talk about PepsiCo.
PepsiCo. I thought we were talking about high-yield stocks, not sugary drinks.
No. PepsiCo might be known for their drinks and snacks, but they're also a dividend king. 52-year history of consecutive dividend increases.
52 years.
Uh-huh. And their current yield is 3.71%. They've been steadily growing that dividend for a decade.
Wow.
So, it's a testament to their strength, global reach, and their ability to keep up with what consumers want. They're not just about sugary drinks.
Right. They're evolving.
Exactly. They've got, bottled water, teas, snacks, even stuff with less sodium, less calories.
So they're definitely keeping an eye on the health-conscious consumer.
Exactly. But just like any consumer goods company, they're always facing competition and people's preferences are changing all the time.
Right. So it's really important to, keep an eye on what they're doing and are they staying relevant.
Absolutely. Okay, let's try something a little different. Let's talk about real estate investment trusts. We call them REITs. There's a company called Realty Income.
Okay. REITs, those are the ones that invest in properties, right?
That's right. Realty Income is kind of a big deal in the REIT world, known for their monthly dividend payouts.
Monthly.
Yeah.
That's pretty unusual.
It is. And the yield is 6.01% right now. They have a really good track record, good profits, very solid credit rating.
So, monthly dividends, I mean, that's going to be really attractive to people who are, looking for that steady income.
Oh, yeah, absolutely. But REITs can be, sensitive to changes in interest rates.
Yeah.
So that's something to keep an eye on.
Absolutely. So, ready to go global again.
Yeah, let's do it.
So let's talk about Rio Tinto.
Okay.
So, what do they do?
Rio Tinto is a global mining giant. They're big in iron ore, copper, aluminum.
Oh, wow. I mean, those are pretty essential commodities.
The building blocks of modern infrastructure. I mean, they're used in everything.
So, with so much going on in the world, all the development and everything, I imagine they must be doing pretty well.
Yeah, they're doing well, and they're sharing that success. 7.45% dividend yield.
Wow.
History of dividend growth. But you got to remember, mining can be a really cyclical industry.
Yeah.
Commodity prices go up and down based on, global demand, the economy, even stuff happening, around the world politically.
So I guess investors in that kind of company really need to have a strong stomach.
Yeah, that's a good way to put it. Okay. Let's shift from the mines to the world of finance. Let's talk about TD Bank, the Toronto Dominion Bank.
TD Bank, isn't that a Canadian bank?
Yeah, one of the biggest in Canada, but they also have a pretty big footprint here in the U.S., so that gives them some geographic diversity, right?
Right.
They're known for really solid financials. Their dividend yield is attractive, 5.37% right now, and their dividend growth is very consistent.
So they're kind of offering the best of both worlds, that stability and the potential for growth.
Exactly. But as with any bank, their performance is really tied to the economy and any, potential changes in regulations.
So got to keep an eye on both, the Canadian and the U.S. economies.
For sure. And finally, let's talk about another telecom giant, Verizon Communications.
Verizon, aren't they facing a lot of competition these days?
They are. The telecom industry it's fierce. New players popping up all the time, but Verizon's holding their own. They have a huge network, a loyal customer base, and they're pushing into, new areas.
Like 5G.
Yeah. 5G, home internet, and they're rewarding investors with a 7.08% dividend yield and 20 years of straight dividend increases.
Wow, that's pretty impressive. But staying ahead in that game, the telecom game, it's got to be expensive.
Yeah, it is. Building and maintaining that network, especially with 5G, it takes a ton of money.
Right.
So investors need to be confident that they're, managing those investments and getting a good return.
So, it's all about that balance, finding those opportunities, but also, being smart with your money.
Exactly. So there you have it. 10 high-yield dividend stocks.
It's a pretty diverse group, right?
Yeah.
Different industries, a whole range of yields, different risk profiles.
Yeah.
It's really interesting to see how these companies are navigating, the current market.
It is. And it highlights how important it is to do your research, understand the businesses, make smart decisions.
Well said. Now, we've covered a lot of ground, but this is really just the beginning.
Yeah, just a taste.
So we've just zipped through 10 high-yield dividend stocks. I'm ready to really get into some of these companies.
Yeah, let's unpack a few of these, and see what makes them tick. Should we start with Altria? I'm kind of curious about their diversification,
Yeah, 55 years of dividend growth. It's amazing. But the tobacco industry, they're facing some challenges, right?
Yeah.
So how are they dealing with all that change?
Well, they're not just, sitting there watching the world go by. They've been really active in diversifying beyond just, cigarettes. For example, they've put a lot of money into smokeless tobacco. Their Copenhagen and Skoal brands, they're doing really well.
So they're trying to appeal to people who are, maybe looking for alternatives.
Right. And they're not stopping there. They're even getting into cannabis.
Cannabis, wow, that's a bold move for a tobacco company.
It is, but it shows they're paying attention, they're seeing how things are changing, and they're willing to bet on new markets. The cannabis industry, it's got huge potential. Altria, they want to be a part of that.
Yeah, it's pretty amazing to see a company with such a long history, really adapt like that.
Absolutely. Okay, let's look at a company that's in a totally different world. Ars Capital Corporation. You mentioned earlier that they lend to middle market companies. Can you talk a little bit more about what that actually means and why investors should, be interested?
Sure. So middle market companies, those are typically companies that are too big to get a loan from a regular bank,
Okay.
but they're too small to, sell bonds on the public market.
Okay.
So they have this great potential for growth, but they don't have the same access to capital, as bigger companies.
So they're filling a gap, a really important gap.
Exactly. And that's where Heirs Capital comes in. They give these companies the money they need. And because these companies, are willing to pay a bit more for the financing, that means higher yields for investors in Heirs Capital.
Right, that makes sense. But, higher yields usually mean higher risk. What should investors watch out for, if they're thinking about Heirs Capital?
Yeah, well, like any lending business, there's always the risk that someone's not going to pay back the loan.
Right.
So it's really important to understand how good their loan portfolio is. Are they lending to companies with solid business models, good management, and companies that can, weather the storm if the economy takes a hit?
So it's really about, doing your homework, looking closely at the companies they're lending to.
Absolutely. Okay, let's switch gears again and talk about Chevron. Oil prices are going up. They seem to be in a good spot. What do you think about their current position and where they're headed?
Yeah, higher oil prices are good news for companies like Chevron, and they're being smart about it. They're putting money into new projects to increase production. They're paying dividends, buying back shares, and they're even putting money into renewable energy, for the future.
Wow, so they're playing both sides, huh? Taking advantage of the good times now, but also preparing for what's next.
That's right. They're not just riding the wave, they're thinking ahead.
Now, how about enterprise products partners? We talked about them being in that midstream part of the energy sector. Can you tell us why that's such a good place to be right now?
Sure. So midstream companies, they're like the toll roads of the energy industry. They transport and process oil and gas no matter what the price of those commodities is doing. Their money comes from the amount of energy flowing through their systems.
So they're kind of insulated from all that price volatility, huh?
Exactly. And with their dividend growth, their yield's 6.58%.
Right.
It's a pretty attractive option for income investors. But the big question is, how's the transition to renewable energy going to affect them?
That's true. They may be doing well now, but, what about the future?
Exactly. Okay. Let's move on to something a little closer to home. Nestle. They seem like a pretty safe bet, don't they?
Yeah, people always need to eat and drink, right? And Nestle, they have so many brands that everyone knows. Kit Kat, Nespresso, Haagen-Dazs. It's a huge list. Yeah.
And that's what makes them so strong, They've got this global empire of brands. Everyone loves them. It gives them a real edge. No matter what's happening in the world, people are still buying Nestle products.
Yeah, it's like they're almost immune to the ups and downs of the economy.
Well, not completely. They're still a global company, so there's always currency fluctuations, political risks, and the economy can slow down in some parts of the world. But their diversification and their brands, I mean, it really helps them.
That makes sense. Okay, what about PepsiCo? They're another big consumer goods company with a great track record, but are they keeping up with the times, with everyone wanting healthier options?
That's the big question, and it's something investors are watching closely. PepsiCo, they're known for their sugary drinks and snacks, but they've been expanding into healthier stuff. They bought Tropicana, Naked Juice. They're making low-calorie and sugar-free versions of their drinks. They're even investing in plant-based snacks.
So they're not ignoring the health trend. They're trying to be a part of it.
Right. They're realizing that consumer staples, it means something different now. It's not just about, indulging. It's about health and wellness, too.
Yeah, it's really interesting to see these big brands, adapt and change.
Okay, let's talk about Realty Income. The REIT that pays dividends every month, which is pretty unusual. How do they do that?
It's really about their leases and how diverse their portfolio is. They own over 13,000 properties, all kinds of different industries. They're not dependent on any one tenant or sector.
So they spread their risk really well.
Yeah, exactly. And most of their leases are what's called triple net. That means the tenant pays for, property taxes, insurance, and maintenance on top of the rent.
Oh, wow.
So it gives Realty Income this nice, steady stream of income, which is why they can pay those monthly dividends.
Okay, that makes sense. So they've set themselves up for consistent cash flow.
Exactly. But like with any REIT, investors need to be aware of interest rates, because if those go up, it can cost Realty Income more to borrow money, which can affect their profits.
So those big economic forces, they always matter.
Absolutely. Now, Rio Tinto, the mining company, we talked about how cyclical the mining industry is.
Yeah.
What are some things that investors should be watching, if they're thinking about Rio Tinto?
Yeah, well, commodity prices are huge. The price of iron ore, copper, aluminum, it can go up and down a lot based on global supply and demand.
Right.
So investors have to be okay with that.
Not for the risk averse.
Definitely not. But for people who can handle the ups and downs, Rio Tinto has a lot of potential. I mean, they're all over the world. They have a variety of mining assets, and they're really efficient.
So they're ready to take advantage of the growing demand for these, essential commodities.
Absolutely. Now let's talk about TD Bank, the Canadian bank that's also making a mark here in the U.S. What makes them different?
Well, one big thing is their focus on customer service. They consistently get high marks in customer satisfaction, both in Canada and the U.S.
That's huge. I mean, customer loyalty, it's really valuable these days, especially in banking.
Exactly. And they've been really careful with their lending, which is why they've done better than some other banks when the economy's been tough.
Okay.
And they do both, retail and commercial banking, which helps protect them from, economic shocks.
So they're kind of a mix of stability, growth potential, and they're good to their shareholders.
That's right. And last but not least, Verizon. The telecom giant, they're in a tough fight. How are they preparing for the future?
Well, they're investing a lot in 5G. That's a big clue. They're building this nationwide 5G network.
5G is the hot topic these days.
Yeah, it is. And Verizon's going all in, and they're expanding into new things, home internet, streaming services. They're realizing that telecom is about more than just phones.
So they're trying to be the place where you go for everything, all your communication needs.
Exactly. And they've got the brand, the customers, and the money to make it happen.
Yeah, it's really exciting to see how all these companies are changing and adapting.
Yeah, it shows you that even the biggest companies can't just sit back and relax. They have to keep innovating, keep changing, stay ahead of the game.
Well, we've really dug into these 10 high-yield dividend stocks. Each one has its own story, its own potential, and, of course, its risks.
Yeah, it's been quite a journey, hasn't it? From, those everyday products to energy, mining, and even telecom.
It really has. So out of all the companies we talked about, is there one that, really stands out to you? One that you think is a really interesting opportunity?
That's a tough one. I mean, they all have something to offer, but if I had to choose, I think I'd go with Realty Income.
Oh, Realty Income. Why them?
Well, a couple of reasons. First, their business model is, it's really solid. Like we said, they own tons of properties and they're in all sorts of industries, right? And their tenants, they handle most of the costs. So Realty Income has this really steady income stream.
Which means they can pay those monthly dividends that everybody loves.
Exactly. And the second reason I like them is I think they're in a good position to benefit from some of the big changes happening in the economy. Like, take e-commerce, for example. It's actually been good for a Realty income. A lot of their tenants, drugstores, grocery stores, dollar stores, those kinds of places, they did really well during the pandemic.
So even though they're a real estate company, they're benefiting from online shopping.
Yeah, exactly. They've been smart about choosing properties that aren't going to be hurt by e-commerce. And, they focus on those standalone buildings, drive thrusts, things like that.
So they've adjusted to the new world of retail.
Right. They're not just sitting there collecting rent. They're making sure their properties are going to be profitable for a long time.
Okay, that's good to know. But we've talked about risks with all these stocks, so what about Realty income? What should investors be thinking about?
Well, like any REIT, interest rates matter. If those go up a lot, it could cost Realty income more to borrow money, and that can cut into their profits.
So it's all about watching those big economic trends.
Exactly. And it's important to remember that real estate, it goes up and down, it's cyclical. Realty income's done well, but they're not immune to, a bad economy.
So diversification is important, like always.
Always. Don't put all your eggs in one basket, no matter how good it looks.
Good advice. I think we've given our listeners a lot to think about today. We've covered a lot of ground with these high-yield dividend stocks.
Yeah, we looked at how their businesses work, what their growth potential is, and what risks to watch out for. But remember, this is just the beginning.
Right. We're here to help you at the Investors Library. We want to give you the information you need to make smart decisions, but ultimately, it's your money, your choices.
Do your research, think about your goals, how much risk you're comfortable with, and how long you want to invest for.
And remember, investing, it's not about getting rich quick. It's a journey.
Yeah, it's about being smart, being patient, and maybe you'll find some hidden gems along the way.
Absolutely. Until next time, happy investing.